Okay, so now we're going to talk about writing off uncollectible accounts or accounting for uncollectible accounts. And this is our bad debt accounting. Now, there are two general ways. One way is the allowance method, which is GAAP. The other way is the direct write-off method, which is non-GAAP. Right? The direct write-off method is when you wait until the customer defaults to write the account off. So we wait until default and before we actually go to write the account off. And that's not acceptable under GAAP. Only acceptable for tax purposes, not acceptable for financial statement purposes. The only case in which it can be used in a financial statement reporting scenario is if the uncollectible amount is immaterial. Right? So if it's just so small we don't truly care about it, then we would say, do what you will, just record it. Right? So when the specific account is determined to be uncollectible, which may not occur in the period of sale, then the journal entry to record the bad debt expense would be a debit to bad debt expense and a credit to accounts receivable. Again, this is direct write-off. And notice that I stipulate it may not occur in the period of sale. So we might have sold something, say, in December and recorded account receivable, sales revenue. Then it comes to January, the person doesn't pay us, can't pay us, defaults on us. And then we record this bad debt expense in January and credit their account receivable in January. So why is that bad? The matching principle, right? It makes no attempt to match revenues and expenses. Remember that the availability of credit sales increases the sales for customers who would prefer not to pay cash delivery. So we're increasing our overall sales. It expands revenue sales, but it also exposes us, the firm, to the risk of non-payment. And so we have to match the risk of this expense, the risk that someone's going to default on us, to the period we made the sale. Remember, the matching principle. How many more times can I beat it into your heads, right? Just make sure you understand that. It does not result in receivables being stated at a net realizable value. The only way we get the net realizable value is by taking accounts receivable and subtracting off the allowance for doubtful accounts. That gives us our NRV, right? Well, in this case, we don't have an NRV because we don't have any allowance for doubtful accounts. We don't have any estimate of what will go bad. We just write it off when it does. So let's turn to what is acceptable under US GAAP, the allowance methods. Right? At the end of each accounting period, whatever that may be, we'll talk about when this happens, estimate the expected losses from uncollectible accounts. So the journal entry is a debit to bad debt expense and a credit to the allowance for doubtful accounts. Remember, this is a sort of holding ground for our estimate. We keep tossing more estimates and more estimates of what's going to go bad in there. And this is just a accumulation of all those estimates. When an account does go uncollectible, then it's written off, right? So when it does go uncollectible, we reduce the estimate because we actually write it off in reality. Reduce the estimate of what will go bad because we have reduced the actual account. So it's a placeholder until we actually write it off and then we take it out of the account itself. And then again, note, I said this in the basics and it bears repeating. This is a trick question that I like to ask my students when I was an intro professor. Does writing off an account affect the net realizable value? And people will typically say, of course it does. I'm writing off an account. My net realizable value goes down. But it doesn't, right? So what am I doing with this entry? I'm reducing my allowance for doubtful accounts. So I'm reducing something that I'm subtracting, but I'm also reducing what I'm subtracting it from. So if this were 10, and this were 3, and I reduced them to both by $1, 9 and 2, notice both of those give me 7. So that's the nice thing about an allowance method, is that when we actually have the write-off, it doesn't affect my account balance. So if I wrote off a crap ton of receivables, as long as it doesn't exceed my estimated amount of bad accounts, it won't affect my overall balance of receivables, right, on the balance sheet. So now there's 2 methods for doing this. There's one called the income statement method, one called the balance sheet method. One is also sometimes called the percentage of sales. One is called the percentage of receivables, because in this method, we apply a percent to our credit sales. In this method, we apply a percent to our gross receivables. So the 2 have pros and cons, as most things in life. Compared to the balance sheet method, the income statement method, theoretically more appealing. Why? Because we take a revenue thing, a revenue item, credit sales, net credit sales, and apply a percent to directly establish my bad debt expense. So we have a very direct correlation between the revenue and the expense we want to match to the revenue. So bad debt expense will equal my net credit sales times percent, whatever the historical percent. This is something that each company estimates. Based on historical records. Just like depreciation. And that's your bad debt expense. You don't have to do anything else. You plug that bad debt expense in for your amount up here. That credits your allowance for doubtful account. Done. Okay, 1-step process. The balance sheet method is a 2-step process. So here we're determining an income statement item and plugging it in, and it's affecting a balance sheet account. Here, we're going to be doing something a little different. We take the gross amount of receivables, so whatever this balance is, multiply it by a percent to determine the balance of my ADA account. So this multiplied by a percent gives me another balance. That's why we're calling the balance sheet method. We estimate the ending balance of the allowance for doubtful accounts by taking the ending balance of accounts receivables times a percent to give me a balance. Notice we haven't solved for bad debt expense yet. We just solved for the ending balance of the allowance account. So now we get bad debt expense by looking at where the account is before adjustment and then comparing that to where we want it to be after adjustment. So we might have, 5 here, and then we calculate a percent and we say, well, we really want 12 here. Well, then that means we'd have to make an adjustment. That adjustment would be a $7 credit, which means that I would want to credit ADA by $7 and debit my bad debt expense by $7. Right? So we figure out the balance, and then we determine what entry we have to make in order to achieve that balance. This is a balance sheet method. This is an income statement method, because here we're taking an income statement account, multiplying a percent, getting another income statement item. Here we're taking the balance of a balance sheet account, multiplying it by a percent to get the balance of another balance sheet item. People will screw this up again and again and again. They will take the ending balance and multiply a percent and say, there's my bad debt expense. No. If you take a balance sheet balance, you're determining another balance sheet balance, all right? Don't make that mistake. I say that, and at least 2 of you will. I know it, because it happens every semester. But please, prove me wrong this time. Please, please, please. Now, overall, the balance sheet method provides a more accurate estimate of the net realizable value of receivables. I'll talk about this in class. We'll work through an example, and you'll see. The idea is that it checks what your prior balance is before reconciling to a new balance, So if you already have a glut or an overabundance of your ADA, it may not really be in the best interest to increase it higher. Whereas this method, the income statement method, ignores it. And again, I'll show you through a method. The method also will typically use what we call an aging of accounts, where each outstanding account is classified by the amount of time it has been without payment. And then we can start to reconcile, all right, well, we think 20% of the accounts past 120 days are going to be delinquent or deficient, default. However, the ones within 30 days, only 5% of those. So we can adjust percent of accounts that are going to go bad by a reasonable estimate of when those were made, rather than just all credit sales this period by the same amount. Right. So let's look at an example. I start off with an accounts receivable balance of $200,000, an allowance for doubtful accounts balance of $1,000, and then I have some entries that occur. Now, I'm going to go straight to the T accounts because I have mastered journal entries at this point in my life. You may not want to go so fast, right? So, depending on your unless I ask for the journal entries, you don't need to give them to me. So the $200,000 debit balance, the $1,000 credit balance here. So the starting net realizable value, 1116 NRV, is going to be what we see on the balance sheet. That's going to be 200 minus 1. So that's 199. Let's see what happens. Sales revenue during 2016 amounted to $800,000, 75% of which was on credit. So I got $200,000 of cash, and then $600,000 of credit sales. That would credit my accounts receivable. Oh, I say that I've mastered this, and I haven't, clearly. Debit my accounts receivable, credit sales revenue. Cash collections on account, that's what I get for being cocky. Cash collections on accounts receivable during 2016 amounted to $450,000. All right, well, I can credit that because I debit cash and credit the account receivable. A $10,000 account was determined to be uncollectible and written off by Hathor. So $10,000 were uncollectible. We established that. We would debit the ADA by $10,000 and credit accounts receivable by $10,000. We collected a $5,000 account that was previously written off. So that means we collected cash for it, which means that I don't add any more receivables, but I would add that back to my ADA, because if that $5,000 wasn't the bad one, then someone else must have been bad, right? So I reconcile both of these accounts to an ending balance, so that way I can work the balance sheet method if I need to. 1 minus 10 is 9K debit, plus 5 is still going to be a 4K debit balance before adjustment. And then the accounts receivable will be 800K minus 450, which would be 350, and then 340. So if Hathor estimates that 2% of credit sales made in 2016 would ultimately become uncollectible, answer the questions. What is bad debt expense? Well, remember, if we're using the 2% of credit sales, we're doing the income statement method. So we're applying 2% to not the ending balance, right? Not the beginning balance, not the collections, but the credit sales, the $600,000 that we made during the period. 2% of $600,000 would be $12,000. Remember, I have just solved for my bad debt expense. Nothing else is necessary. Oops. Yep. What is the balance in the allowance for doubtful accounts after adjusting entries are made on December 31st? Well, after I make this adjustment, remember, it would be a debit to bad debt expense of $12,000 and a credit to ADA of $12,000. So that would mean then I would take my ADA and credit it by $12,000. So it started at 4K, I credit it by 12K, and then I get 8,000 left over. That's all you need to know. That's all you need to do. What is the new NRV? I could ask that too. NRV at 12/31/16. Well, then that would be 340,000 minus 8,000, because that's the ending balance of accounts receivable, the ending balance of my allowance for doubtful accounts, not accounts receivable minus bad debt expense, right? Not the adjustment we made to ADA. These are all things I see on the test, and they're all such easy little points to miss, right? Right. So that would be the NRV. Ignore what you did in one. Let's say we use 5% of outstanding accounts receivable to be estimated as uncollectible. What is bad debt expense for 2016? Well, remember, our ending account receivable was 340,000. So we're going to take 5% of that, which should be 17,000, but let me make sure. Yeah. Is that my bad debt expense? No, 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 no. Don't do that. That is not your bad debt expense. That is step one. We have a $4,000 debit balance. This is always establishing what we want as a credit balance. And so in order to achieve this balance in our ADA account, I have to adjust it by $21,000. When I do that, it's a bad debt expense, an adjustment to ADA for $21,000. So my bad debt expense for the period is $21,000, not 17, 21. How would I have to adjust the account to get to 17? What is the net realizable value of accounts receivable after the 12/30/31/16 adjusting entries have been made? And again, I didn't say this before, but this is an adjusting entry, right? We are debiting an expense, crediting an asset, crediting a contra asset. All right, so the net realizable value then, remember, is your gross receivables, 340,000 less, not 21. Don't take 21 because that's the adjustment we made. That's not the balance of the ADA, minus 17K. So 340 minus 17K gives me my NRV. Okay. So which one do companies use? That's a good question. Sometimes they'll use one, sometimes they'll use the other, sometimes they'll use both. So they might use the income statement method to make monthly adjustments. And then at the end of the year, they'll use the balance sheet method to adjust whatever they need to make their ADA on point. Because remember, it's a little more accurate. And in fact, that's what I have you do in one of these problems, where I give you a lot of information and make you update the balance at the end of every month by the income statement method, and then do a final adjustment by the balance sheet method, which is a great practice because look at all this. You get 12 entries. I would make all the journal entries just to practice, 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 and make sure this gets through your head. All right? And that ends that part of Chapter 7 and Module 12.